Hey everyone, welcome back to another video for Ask a CPA. Today's question comes from Mike in New Orleans, Louisiana. Mike asks, hey Brett, I just turned 73 and my financial advisor said I need to start making RMDs from my IRA. How do I calculate it and what happens if I don't take it? Now Mike, this is a great question, so let's go ahead and break this down. Now remember, Mike submitted this question through our website at askacpa.co. You can submit your questions there as well, or leave them in the comments down below. And while you're down there, make sure to hit that subscribe button. Now, for those of you who don't know, an RMD, or required minimum distribution, is the minimum amount that you're required to withdraw from your retirement account each year once you hit a certain age. Now, you're allowed to take a larger distribution than this calculated amount, but you must take at least this minimum amount. Now, if you're born before 1951, you had to start taking these at age 72. But if you're born after 1951, you can start taking these at age 73. Now, in 2033, the RMD is going to increase in age again up to 75. So, Mike, since you just turned 73, this is going to be your first year taking the RMD. So let's go ahead and go over how to calculate it. Now, first, we're going to look at your retirement account balances as of December 31st of the last year. Now, this includes your IRAs, your 401ks, any other tax-deferred retirement vehicles, and that's the number we're going to use for this calculation. Next, we're going to find your age on the IRS Uniform Lifetime Table. Now, the IRS assigns a number called the life expectancy factor based upon your life expectancy and your current age. So, for example, if your age is 73, your life expectancy factor is going to be 26.5. If you're 80, your life expectancy factor is going to be 20.2. The older you get, the smaller this factor gets, which means the larger withdrawal is going to be that you're going to have to make. Now you're going to take that number, your year-end balance, and divide it by your life expectancy factor. So let's say your IRA had a balance of $500,000 at age 73. You're going to take $500,000 divided by 26.5, which is going to give you $18,868, and that is your required minimum distribution for the year. Now you're going to have to go back and recalculate this on an annual basis so you know each year what your RMD is. Now, if you don't take an RMD, the IRS is going to hit you with a huge penalty. You could face up to 25% penalty if of the amount you should have withdrawn. But if you correct this quickly, the IRS will drop that penalty to 10%. But still, it's a tax that you do not want to pay if you don't have to. Now, most financial institutions will calculate and distribute your RMDs for you if you can set this up on an automatic process. So you don't want to wait, so you don't have to worry about this every year. Just go ahead and set that up on an automatic withdrawal, and then you know you're good to go on your RMD. So Mike, I hope this video was helpful. If you have any tax or accounting questions, hit us in the comments down below or email us at, or you can submit them through our website at askacpa.co. Thanks so much for watching, guys. We'll see you in the next video. Make sure to hit that like and subscribe button, and we'll see you next time for Ask a CPA. Take care.